Hello everyone, good morning. My name is Vikas Agrawal. I am the founder of AIF and PMS Experts India. So as all of you know that we believe in educating and empowering our investors, and therefore we keep organizing these knowledge-based sessions which we call it Ask the Expert. So with me I have Mr. Siddhartha Rastogi with me. Hello Siddharth, thank you for taking the time out from your busy schedule, coming all the way from Bombay to Pune and agreed to come on the show and speak to us and our investors. So at AIF and PMS Experts India, we keep organizing these shows, and idea is to, as I said, talk about financial literacy, because that is something we feel that in India is missing big time. So therefore we focus more on that, and we're glad to share that we are recording this session for the first time from our office. So it's a different feeling altogether. Let me have the privilege of introducing Siddharth, and Siddharth is the Chief Operating Officer. He's also the Principal Manager. He's also the Head of Sales at Ambit Capital. Well, I'm going to ask you how is he managing these three different roles all together. But before that, let me just tell you that he brings about more than 2 decades of experience when it comes to investing in Indian markets, and he's worked with large organizations. So he's started his career with UTI, then worked with Citi, then HSBC. He was the founding member at IFL when they were starting up their journey in India. And then he joined Ambit. He's been there for quite some time now, heading the entire PMS division. So we thought today we will try and read his mind, understand more about how to invest in PMS more particularly, and also talk about the various strategies that they run. So thank you, Siddharth, once again. So my first question is that if you can just tell us your personal experience of investments, and also give us some bit of introduction about your organization and the capabilities of Ambit.
Sure. So firstly, thanks PMS, AIF experts, AIF PMS experts, and thanks Vikas for having me today at Pune. It's a wonderful weather and a wonderful team to have a conversation on the financial investments, financial planning. Essentially what you're talking about is how Ambit is capable and how Ambit can enable you to meet your financial goals, your financial targets, and more importantly create multi-generational wealth. So let me first, as Vikas asked me the first question, let me talk about Ambit and Ambit's capability. So Ambit is a full service investment bank. We have been in existence for over 25 years. We have 6 verticals, starting with investment banking. We are one of the biggest players in the institutional equities market. What does that mean? It means that we not only advise the domestic institutions, but what FIIs buy, when do they buy, how do they buy, what do they buy, we solve for it as well. So one of our verticals enable that. The third vertical is asset management, Ambit Asset Management, which Vikas introduced me, and where I look after that business. So Ambit Asset Management manufactures portfolio management services, and we run 4 strategies, 4 portfolios. We'll talk about it. The 4th line of business for Ambit is NBFC, non-banking finance company, where we give SME lending. The 5th line of business is ECM, equity capital markets, where we bring unlisted businesses to the listed business, to make them listed business. So we bring them from the unlisted side to the bourses. We enable your money, investors' money, to participate into the growth of these companies. So that's the 5th line of business. And the 6th line of business for us is the private banking. So we help businesses or promoters to write their wills, to do their estate planning, and to ensure that if they need any transactional support, transaction essentially means, since we are a corporate finance guys, so if they need any help on the unlisted side of the transactions, that we bring on the private banking side. So in essence, Ambit is a full service investment bank. It's very interesting that all the verticals are actually conjoined with asset management. And why do I say so? Three things are key in any asset management or manufacturing business. Manufacturing, when I say manufacturing of financial products.
Sure.
So what do portfolio managers are supposed to do? Three very, very simple things.
Yeah.
Identify the businesses which are good and clean, which have great capabilities, but which have huge ethics, integrity, high corporate governance, as well as promoters' skin in the game and promoters' willingness to continue. So there is no business which can thrive if the promoter is not committed, not only to his own interest, but to the minority shareholders. Minority shareholders is the key. And that's where our group businesses help us with the corporate access. So as I mentioned about that, we are one of the biggest players on the FI and the DII side. It gives us huge amount of corporate access, which a lot of other groups may not have. That's
Sure.
number one.
Sure.
Number two, we are one of the biggest M&A players. Hence, we understand, despite of M&A, which businesses are able to grow on an organic or on inorganic basis. So we have capabilities when there is a special situation or an event which happens in a business, whether it will fructify to become bigger or it will pull down the business altogether. So that's the second capability which we are able to decipher as portfolio manager, and thanks to our group companies. Sure. The third thing is, since we already have an NBFC, our understanding on the BFSI businesses is very, very large. Whenever we see a massive slowdown in the lending cycle, we cross-check whether it is company specific or whether it is industry specific, whether it is country specific. And that enables us to understand and bring things in the right perspective. So in a nutshell, the portfolio manager is supposed to research, is to ensure that he maintains good ethics and there is no common interest between the portfolio manager as well as the businesses in which he is investing. That's number two. And number three is impeccable service. Impeccable service. So because of all the group businesses, our DNA is to do forensic accounting. I'm using the word very, very specifically, forensic accounting. Ambit, before it started as a full service investment bank, it had a pedigree of RSM, Ratan S. Mama, which was one of the big tax advisory, tax consulting firms. So our DNA is not broking. It is not trading. It is not churning. Our DNA has been research, reading books of accounts and doing forensic accounting deep down. Hence, we understand businesses which are cooking their books of accounts. We understand where there is malified interest in representing the books of accounts. And it's a very interesting phenomenon. If you look at last 4 years, roughly around 20 to 25 businesses in India have lost market cap in excess of 90%.
Oh, that's a big number.
90%. And all of them have some challenges in their annual books of accounts. Now, if you are able to remember, there is a convoluted thinking in investing. People believe that money is made in equity investing on the upside. No. It is made on the downside by protecting the downside. Why do I say so? I'll give you a very simple example. Ambit coffee can portfolio, when COVID struck, nearly 28%, Nifty was down in a matter of 3 to 4 days into 3 to 4 trading sessions. Coffee can was merely down by 9 to 10%. It essentially means Nifty needed to deliver nearly 40% returns from where it was to only go back to the principal where it started 3-4 days back. Coffee can needed only 11%. Now,
protecting downside
protecting downside is more important than delivering upside. Now think about it. When the market will boom, everything will boom.
Sure.
But even if you're underperforming in a very buoyant market by 3-4% does not matter. What matters is how do you protect the downside. And that's what forensic accounting, reading the books of accounts and figuring out things which are not so clean, things which are not so consistent, things which are having some challenges in their representation, what numbers they are quoting, that makes a hell lot of difference.
So knowing the fact that now you have institutional capabilities in terms of doing complete research, also doing M&A, also doing investment banking and private banking. So in a way, it's a pure investment per se house, So, well, asset management would have been the natural line of business for you guys. Any plan for you all to think about coming out with mutual funds in future?
So very good question, because although we would love to be part of the mutual fund business, but at the moment we are not thinking of entering into the mutual fund line of business. Currently we have PMS as the line of business. We run 4 strategies, and I am happy to share that we will be coming out with the alternate investment funds, and they are unique. We have always come. So if you look at the reason why Ambit came into the portfolio management services industry is not to become just another participant. When the entire portfolio management industry was going through this rigmarole of increasing risk and thereby increasing returns, what we said, de-risk equities, reduce the risk in equities. Hence, our thought process, as I mentioned earlier in the conversation as well, that our thought process is always to make sure that we bring uniqueness, some acumen, using our acumen, bring some proposition which is unique to the investors. And similarly, when we will come with our alternate investment fund, it will be unique in its own kind. I don't want to disclose anything before it gets ripped out, but very clearly there will be an opportunity which is vacant, where we see that this place is not just out of the rut, out of a regular course. It will be a unique proposition which will come. Coming back to the mutual fund, we believe it's a crowded marketplace. We believe that there is not too much of scope of innovation in there. There is a lot of index hugging which happens there, and if there is index hugging, then there is limited value addition you can do from the client's perspective. So that's the reason, for the moment, at least in the finite future, I don't see Ambit entering into the mutual fund space.
So couple of questions I'll keep asking. So the next question is, so mutual fund to sahi hai, Siddharth, and you have more than 2 decades of experience, personal experience of investing your own money, and you've been investing your clients' money. But you are a boutique PMS house, right? At this point of time, you don't have any plan to come out with mutual fund schemes.
Correct.
So mutual fund to sahi hai, we saw that for last 2 decades, we've been investing our own money, and it has been doing well. Of late, what we have seen, and I want to talk about that, and I want to take your views on that. Of late, we have seen a lot of HNI investors and ultra HNI investors. Initially, it used to be only institutional, but of late, these HNIs and ultra HNIs have shown a lot of interest towards alternate investments funds that you talked about, and also portfolio management services. We were very clear that we want to only focus on this because we bring a lot of expertise on the table. So your opinion particularly, because during 2000, 2001 or 2 times, mutual fund industry used to be where today PMS industry is in terms of size, which is about, I'm talking about only domestic retail participation and HNI participation. The PMS industry is about 2 lakh crores.
Perfect.
And your AIF industry is about 1.10 lakh crores.
Perfect.
So your opinion, how do you see? And second question on that, why should investor consider investing in these 2 instruments? Over to you.
Okay. So the first question is that, where do I see the industry growing? I see that the way Indians are getting towards the financialization of their savings, this industry may become 17 to 18x 17 to 18x, maybe 20x in next 10 years time frame. So by the middle of the next decade, somewhere in 34, 35, I won't be surprised the number which you just said is 2 lakh crore, maybe over 25 lakh crore, maybe 40 lakh crore.
Quite a big number.
So, and there is a reason behind it. There is a reason behind it. The first reason is, so this industry is poised to grow nearly 20 times in next 10 years. It's a whooping number, but why do I say so? 3 very simple reasons. Number 1, the number of millionaires which India is adding every month, every year is highest than ever in the 75 years of Indian history. It's one of the fastest in the world. China used to lead that. Now India is leading that. So that's number 1. So the people of India are creating wealth at a significantly higher pace. That's number 1. Number 2, there are only 4 asset classes literally which SEBI allows one to invest in: debt, equity, gold and real estate. That's the 4 legitimate investment asset classes. Then there are all mix and match, and then there are variation versions and investment solutions which revolve around it.
Sure.
If you look at barring equities, all three on a post-tax basis is not meeting inflation, the inflation which is applicable to the middle class or to the upper middle class. What is the inflation which hits? Packaged food, transportation, EMIs.
Yeah.
That's it. These are the 3 biggest spaces where, and entertainment, on all of them, the inflation is constantly in the range of 7 to 8%. Now tell me which other asset class, barring equities, can give you anything from 2 times to a 3 times inflation potentially over a period of time. Kagar, there isn't anything. So what has happened is interesting, that equities from here on is not an option, it's a compulsion. Equities is not an option but a compulsion. If that is a compulsion, then what investors are trying to do is invest in equities because they want to protect. So that's the number 2. Number 3 is, we saw when China's economy moved from a $2 trillion economy to a $5 trillion economy, which was somewhere between 2002 to 2008 early, the financialization jumped by nearly 40-45%, which means the savings, incremental savings going into the financial assets increased multifold. And that's the same trend which we are already witnessing post-COVID, and it continues, and you guys are the experts, you guys have seen the data. Despite of challenging times between January 2022 till about June 2022, despite of FIs selling nearly $33 billion, Nifty corrected only by 14%, 1/4.
Yeah.
Compare it to 2008, when Nifty corrected by 52% calendar 2008, and when FI sold nearly $24.5 billion, which means they sold nearly $7.5 billion more. Now, I'm talking dollar terms, this is not in rupees. Despite of that, the Nifty correction was 1/4, almost 1/3, 1/4 of what one witnessed. So who was buying? It was the domestic institutions and the domestic money, literally retail like you, like me, people who have now started. I always believed in India, people who have recently started believing in India's growth story and investing in India's growth story.
Sure.
So the financialization of economy is the 3rd biggest reason. Equipped by smart platforms like you, who's giving transparent information, ease of execution and great service. That's the combination. Today's youth want quick access, straightforward information with no ifs, no buts, no side pocket business, straightforward, straight costs, and is willing to invest. And that's what is happening.
So we, Siddharth, thanks for sharing this and throwing more lights on this. So we keep getting this questions from our investors that, what is the major difference between mutual fund, AIF and PMS, and why should they consider investing in AIF and PMS?
Perfect. So SEBI, again I'm going back to SEBI because I always believe that regulator is always like a father. The regulator's interest is to make sure that everybody remains disciplined, and it benefits the last man standing as well.
Wow, what a wisdom.
So what the regulator did is, regulator created 4 platforms to invest in listed equities. I'm only talking about listed equities at the moment.
Yeah.
One is direct broking, where you can open your broking account with various platforms, online and offline, and you can place your order. Some people may give unsolicited advice, but that's the call which you are taking without any understanding of the business where you are investing in. You can buy and sell stocks. So that's a direct broking. The second is the mutual funds, where lots and lots of people give their money, pool in their money, and when the pooling in the money happens, then the fund manager decides where the money will be put in. So that's the second way. And the third way is the portfolio manager, where the portfolio management services invest separately for you, separately for me, and there are segregated portfolios. What is bought for you may not be necessarily bought 100% in identical with of my money, and there is a separate demat for you. There is absolute transparency, absolutely iron block between A investor and B investor and C investor and D investor. So there is no pooling in. AIF is only for the sophisticated investors, people who understand the risk associated with it, because these are specialized offerings. A lot of them are also logged in. Hence, this is essentially for the diversification perspective. It is for the perspective that people who want to take higher amount of risk and then rely on the wisdom of the investment teams, investment managers, and then they give money. So these are the 4 platforms. We also understand the difference between all of them. So broking can be done with any amount. Any amount means literally any amount. You can start with 100 rupees as well. A mutual fund essentially starts with 5,000 rupees, and a SIP can be for 500
rupees. Yeah.
Absolutely. And PMS, portfolio management service, start with 50 lakhs, and AIF starts with 1 crore. So these are the distinctions. But what is the key investment distinction? So let me explain to you in a very simplistic fashion, very simplistic fashion. Broking, you understand, there is no wisdom, there is no understanding. You just buy on hearsay. And the problem with hearsay is very small and very simple, that if you buy on a hearsay, the person tells you when to buy, but if the stock goes down, he does not have the answer why the stock is going down and when to exit.
Yeah.
And when to average or when not to average, there is no advice. Just over a phone call, somebody has given you a tip and you have bought, whether a penny stock, whether a big stock, does not matter. And when the sky starts falling, then when you realize the truth of the research, the importance of the research.
Correct.
So we'll exclude that for a moment. Then we come at the mutual fund stage. The mutual fund, remember that I spoke about the minimum ticket size. Now, there is nothing good, nothing bad which is there with the mutual fund, because mutual fund is created with a perspective of having inclusion, which means how can the last man standing, the weakest of the weak, also participate in the India's growth story. There is no other vehicle other than investing into the India's equity story, because that's the only way you can participate into the wins of India.
True.
Now, if you have to do that, then mutual fund is the best vehicle. But the problem is very simple. The person who's saving and investing 5,000 rupees, 7,000 rupees, 8,000 rupees has a different goal, has a different financial need, has a different financial importance to the money he or she is investing into the mutual fund, versus a person who's investing 50 lakhs, person who's investing 2 crores, person who's investing 5 crores or 50 crores. Now, fund manager does not know whether to solve for someone who is having 5 crores, 50 crores or 5,000. Hence, it's always the least common denominator. So what does the fund manager do? He always protects or sees the interest of the last man standing and is solving for that person, which is the investor who's investing for 5,000, which means he or she will try and put a performance which is only relative to the benchmark, because
closer to the benchmark.
And what he will do is he will do three very simple things. He wants to reduce the risk, so he will diversify. He will do excessive diversification. So that's number one. Number two, he will, as you rightly said, he will be very, very close to the index. So maybe
he can't afford to go away from the benchmark.
So the benchmark businesses and benchmark weights will comprise of large part of the mutual fund portfolio. So that's number two. So if the Nifty is falling by negative 20, it has fallen by 20 or is negative 20, as long as the fund manager is delivering negative 19, he is looking pretty. At the same time, if the Nifty is doing 12 and if he is doing 12 and a half, he is looking pretty.
Because the thought process is that they don't want to have impact on retail investors' life.
Absolutely, bang on. And the third thing which the mutual fund manager will always look for is, if it is a small cap or a mid cap stock, have a larger number of stocks. In some cases 50, in some cases 60, in some cases 80. Now the problem is very, very simple now. The problem lies there. The problem is, can a fund house, any fund house, and if you look at AUMs, in equity AUMs ranging from 50,000 crores to 5 lakh crore, 50,000 crores to 5 lakh crore, they would have a fund manager, a CIO, they would have 3-4 fund managers, they would have 6-7 analysts, a team of 10 to 12 people managing 50,000 crores to 5 lakh crores, deciding into the investment of stocks which may range between 100 to 400. Now, is it humanly possible to do deep dive research into those 400 stocks by a team of 12-13 people?
Next to impossible.
It's impossible. Let's be honest and let's be frank. It's impossible. Hence, what do? They look at the macro, they look at the micro, and they look at a lot of small parameters, and they do their best due diligence possible, and they do it. On the other side, when we look at the PMS, PMS generally has a very focused approach. I'm quoting about Ambit PMS.
Correct.
Ambit PMS, whether it is Ambit Coffee Can large cap portfolio, Ambit Good and Clean mid cap portfolio, Ambit Emerging Giant small cap portfolio, and Ambit 10x flexi cap portfolio with a mid and small cap bias, have not stocks more than 20 in number and not less than 15 in number. So
your portfolio would have 15 to 20 stocks.
Absolutely.
So very focused approach.
Our universe of research itself will not be more than 100 in number. Maybe 70, 80 to be exact. And then we do deep dive research. We have a thorough research process. All fundamental, all done by us. Our research and fund management team altogether is 11 people. So what I'm saying is, if I use Ambit as an example, Ambit portfolio management as an example to show you what capabilities or what PMS does, is they do deep dive research.
Sure.
And
so these are essentially high conviction ideas. So chances of meeting accident is negligible.
Yes. So the errors are far and few or almost negligible. That's number one. Number two, our thought process is to own the business, not the stock.
Sure.
Own the business maybe for 5 years, maybe for 8 years, maybe for 12 years. We never start with a thought process of cutting down within 1 or 2 years. We have some stocks which is in the oldest portfolio, Good and Clean mid cap portfolio, as high as 7.5 years old, and we are still holding them. So the thought process is very, very simple. In equities, more money is lost because of two simple reasons. Ladies and gentlemen, here, two simple reasons. A, we keep averaging our losses. And second, we keep cutting the legs of our fastest horses. we keep cutting the legs of our fastest horses, and that's what happens. The stock which could have become a 10 bagger, 20 bagger, 30 bagger, 40 bagger. Yeah. So more money is lost in the market. More money is lost in the market when people cut the legs of their fastest horses and they keep averaging their losses. So it's very, very funny that in mutual funds the churn in the stock happens every 2 months, 3 months. When you buy a stock, you know that the external environment is uncertain and it will remain uncertain. Mm-hmm. But despite of that, the churn is very, very high. Now, that's the thing which PMS provides you against. PMS, portfolio management services, helps you to keep having businesses which can grow into multiples over longer periods of time. So that's the key difference. And hence, if you have reasonable time frame with you, PMS essentially is a great strategy to invest.
See, the other thing which that's my observation, what I have seen in my career of last 20 years is that there are times when mutual fund companies, and probably you can add wherever you feel like, because you have an institutional research team,
correct.
They are not able to reach out to companies which are now small but have the potential to become large in future,
right,
because of their mandate that if they invest in particular stock, and because of their size they'll have to put 50 crores or 100 crores, but at times the liquidity do not allow in the stock for the mutual fund guys to participate, and that is where sometimes PMS manager picks up the high conviction ideas. For example, not to forget that Bajaj Finance used to be less than 100 rupees 1.5 decades back, which is now one of the fastest growing. So at one point of time they were the smallest of the smallest company, and then it was initially picked up by all PMS guys, and then later mutual fund guys started participating. So that is one observation that I have. It is PMS per se, they have the capabilities to go beyond the benchmark. They can afford to do so because they get that mandate from HNI investors like you, and then they afford to go out, pick those companies at an early stage of their growth curve, right through the growth journey, and then mutual fund guys come and start participating.
Absolutely.
So probably you can say, because you have that institutional research team. What's your observation there?
Absolutely. So what you said is absolutely correct. See, I would not say that there's too much of fault of the mutual fund managers as well, because regulated to protect the interest of the common, of the small
retail investors,
retail investors, small investors. They have put a cap. So large cap means top 100, then mid cap means 100 to 101 to 250, and so on and so forth till 500.
Yeah.
So there is no possibility, whilst India has 7,460 listed companies. I'm not saying you go at the bottom, you remove even the companies which have a market cap of less than 1,000 crores.
Sure.
There are great companies, unlevered businesses, no debt businesses, high conviction ideas which stay beyond 500. Now what happens generally, the analysts only cover a business when they come in the BSE 500, but beyond BSE 500 nobody looks at them, because ultimately research analysts also have a bandwidth issue, and that's where the PMS managers, PMS research team comes into play, where they do deep due diligence. They meet the management, they meet the ex-employees, they meet the wholesalers, the retailers, the distributors. The entire 9 yard is covered by the PMS managers. And for us, I can talk about Ambit. Ambit takes nearly 6 to 8 months before we identify a business and then add into our scheme. So we do huge amount of due diligence to enter into a business, and that I think is a limitation with the mutual funds.
Sure. So, Siddhartha, we have many investors who have invested in your coffee can investing and emerging business and good and clean. So my question is, and this is one question which really came from one of the investors. He said that, because if I have 100 rupees, and because we were doing mix and match amongst all your 4 schemes,
right,
he said, if I have 100 rupees, how do you want me to put this 100 rupees?
Very simple.
In Ambit, if it is, this allocation is made only for Ambit.
So very good question. Thanks for raising this, because generally investors get confused. What we have done is we have segregated all the schemes depending on their risk appetite. So Ambit Coffee Can portfolio is a large cap oriented portfolio. Ambit Good and Clean Mid Cap is a mid cap oriented portfolio. Ambit Emerging Giants is a small cap portfolio. And Ambit 10x is a mid and small cap biased portfolio. It is a flexi cap portfolio which can have large cap. It's a futuristic portfolio. Now, depending on the risk appetite, so I would always request people who are in the total wealth preservation zone, which essentially means people who are above 55 years of age, they should more skew towards the Ambit Coffee Can portfolio.
Yeah.
On the other side, people who are starting their careers, people who are in the age bracket of 22 till about 40-45, they can take significant amount of risk. They should take a pure play emerging giants, which is the small cap portfolio. On the other side, if somebody have goals to meet with liquidity also required because they want to get their kids educated abroad and they want to have only 5-6 years. Also, there are people who want to save some money for the marriage, for any specific goals, not the retirement goal but other financial planning goals. Then they should do a mix of the Ambit Good and Clean Mid Cap portfolio and the 10x portfolio. Ambit Good and Clean portfolio can help in a relatively shorter run, 4 to 4.5 years, to grow your wealth significantly. 10x, some portion, so do a mix, 25 lakhs in one, 25 lakhs in another one.
So that is an additional advantage that you have. It is you allow investors to divide 50 lakhs because the minimum threshold by the regulator in any PMS is 50 lakhs. So you are saying essentially that if I have 50 lakhs to put, I can put 25 lakhs in Coffee Can and I can pick 25 lakhs rupees and pick any of the strategy and put.
Absolutely. So you can pick 2 of the strategies with 50 lakhs and you can decide.
And if I have a crore, I can divide amongst all
4. Also, you can switch between the schemes. If you're essentially, if you believe that your risk appetite is changing and you believe now preservation, so you can move from the risky and you have made money in the small cap. Now you want to protect, you can move into the large cap. So we give this kind of flexibility because ultimately we exist because of you. So that's the
so point. Couple of quick questions, very quick questions. So first is, do you have an exit load in any of these schemes?
So we have no exit load in any of the schemes. We have an exit management fees. So we have two fee options. We have a variable fee and we have a fixed fee option. In the variable fee, there is no exit load. In the fixed fee, if you exit within 1 year, then you still have to pay 1 year entire fee.
Sure. So basically, it clearly indicates that if you have to have a horizon which is more than 1 year, otherwise no point getting into PMS per se. So no point sitting on the vehicle. The second question, so do you ever take cash calls?
We generally don't take cash calls. However, we leave it to the investor. If you want to take a cash call, we are all right because it's ultimately your money. We always believe in the micro risk. We take the company risk. That's the only risk which we take.
Sure. So, if I give you 50 lakhs, will you put next day in the morning 9:15 or you will stagger?
So what we do is again, as I mentioned, we take the company specific risk. So especially in the mid and small cap, if the stock has run up significantly, for those stocks I may put cash. For rest of the stocks, I will buy in next 3 to 4 days. For some of the stocks, if it has run up significantly, which is beyond my comfort zone, because I constantly keep looking at GARP as a philosophy. GARP, G-A-R-P, growth at reasonable price. Hence, if it becomes too expensive, then I will sit in cash or I will play with the 17th man or the 18th man. So I may not come with a 16th man because he has become too expensive. I'll bring the next horse to run instead of that.
So is it a model portfolio or customized portfolio?
So model portfolio with a customization to the extent of 5 to 10% in case if one stock is very, very expensive. So would all the investors have the identical portfolio? The answer is no. There will be commonality to the extent of 80 to 85%. There can be 0 to 15% variation.
If my risk allows me, is it Coffee Can or Ambit? Emerging opportunity, emerging giant, which one?
Emerging giants.
Okay.
From here.
And why?
Very, very simple. India is growing. You have seen that flows from FIs are coming despite of havoc in the West. For the first time in 75 years or in last 30 years of the stock market, I can actually say that FIs are interested in participating even in the mid caps. Even in the mid caps, earlier they only used to look at only at the large caps. Now they are investing in the quality mid caps, quality small caps as well. Small caps is the place where you can make tons of money from here for next at least 3-4 years. I don't know beyond that. Coffee can is an evergreen portfolio. It's always a green portfolio. You will always enjoy that portfolio. But if you want to make little more money for your pockets, and if you have the risk appetite, and if you are young, if you have cash flows which are coming in your bank account, not touching the cash flows from the PMS, emerging giants is the place to be.
Great. So thank you so much, Siddharth, for taking the time out, joining the call. I truly enjoyed the conversation. I'm sure our investor will also enjoy, because they got a lot of insights about, how should they invest money. And once again, thank you so much, viewers, for watching the show. Thank you.